Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Renan Devillieres. How you doing, Renan?
Hey, thanks for having me. I'm doing great.
Great. Well, glad to have you in the show. Wanted to bring you on to talk about this topic, which oddly enough is so hard to find good people to talk about. So I wanted to bring you on. But before we begin, Renan, tell us a bit about your background.
Yeah, sure. So I started as an engineer in France, but before that, I had lived in like 10 countries. My dad was in the army. And then I started my career in manufacturing, hardcore manufacturing, defense, aerospace, luxury, all over Europe. And then I created a startup, a technological startup. I was lucky enough to get an exit, sell my shares back in 2019. And ever since, I've been an investor in startups specialized in technology for operations, so manufacturing, warehousing, those kind of things. So I consider myself a nerd on the topic of technology for operations and reshoring.
Nice, nice. Well, what's intriguing in the manufacturing space right now? Like, what do you see in the space that's going on that's interesting?
The main thing that is extremely interesting is that the pace of change of manufacturing in the next 10 years, and it started like a few years ago, is literally 5 to 10x faster than the rate of change before. So you have the population aging, including in China. Like we don't have enough people to make stuff. There is geopolitical tension and the China decoupling, especially with the new administration in the US. And so basically, we have to learn how to make stuff in the West back. There is also a lot of fundamental technologies that are shifting in energy, in self-driving, in software that make it so that physical things are about to change. Like if you look at your smartphone and everything digital, the pace of change has been huge in the last 15 years. But if you look at your chair, like the pace of change is zero. The chair that you sit on is probably the exact same type of chair that was made 20 years ago. And that is not true anymore because there are so many advances in all those fields. So it's very exciting times for manufacturing and reshoring.
So, what is what is allowing this pace of ch change to speed up?
So two things can be true at the same time. Very probably we will make less stuff and it will be more important. So for example, when you create a new car like a Tesla and it drives itself, you may be creating less cars, but more people do car time. And both things can be true at the same time. And so, which is true for cars, can be true for a lot of other things. If you think about it, the number of times you use your smartphone during the day is staggering. And so the use of a smartphone as a percentage versus idle time is very, very high. And it is not true of other physical stuff. It is true also for construction, shipbuilding. It is true for defense with a lot of new drones and things coming up compared to the alternative, which is jet fighters that get used once a month. And so that rate of change and of using more with fewer things, like it's a macro trend.
But how does that speed up the rate of change for everything else? Because, like you said, the rate of change for chairs zero, which is probably true because I'm sitting in a chair I've sat in for the last 20 years, so that's probably true. But I'm just curious in terms of so it sounds like that what they're doing is they're manufacturing different things. But is it actually speeding up or is it just adjusting in terms of what is changing?
I think it's speeding up. I think it's speeding up in energy in cars. If you look at General Electric or General Motors, they used to do new models every 2 to 3 years, but it was the same car. uh, now you get new software and new type of cars, and you get cars that self-drive, you get cars that are upgrading themselves with software. And so speed of change and rate of change is high. And which is true for this sector is also true for other things. If you look at energy, the energy infrastructure in America right now is on average 35 to 40 years old. That's the average. And energy needs are going up. And so there is going to be nuclear, there is going to be a lot of new sources of energy. And those new sources of energy are going to be built right now. And so I have, if you want, you will be able to show that chart to your listeners at some point. But the there will be more factories built in the next 18 months than in the previous 5 years combined. That is like sourced the administration. And so this is just because the way that we need to build those things is changing. And so the rate of change is exponentially increasing.
So I'm curious because you mentioned factories and energy, both of which take a especially long time to build. Um, so I'm curious, what in the because well, let me circle back. So we've been outsourcing most of our manufacturing to China and some other areas, especially in the US and other countries as well. And as you said, now we've got to start reshoring stuff. All of that takes time.
Yeah.
So how is it going to work where we have to build new factories, which aren't quick to build, and then we start building new stuff. And on top of that, energy, which you mentioned nuclear, which at least according to the if you have all the old regulatory bodies that existed, could take 20 years to build a nuclear reactor in the US. It doesn't take that long, but with the regulatory, affiliations, that's what happens. So how do you foresee that speeding up, and what's going to have to happen in order to speed up that whole process so we're not looking at 2050 and now we're starting to manufacture in the US again?
Yeah. So there is that sentence that I really love, which is that future is already live. It's just the repartition is just not even. Um, this has started. So US is building chips again, and it is live since like 6 to 12 months, but it is in the making since 3 to 4 years. In the grand scheme of things, um, building the factories take 18 months to 36 months. And then ramping up production takes 1 year, and then decoupling happens. And so a lot of my Morgan Stanley friends, they tell me, yeah, but decoupling with China is not happening. Yes, it's not happening in the outputs right now, but it is happening in the investments, meaning that a lot of people are building the factories that is prior to decoupling. What is true is that with like the new administration, and it is true all over the world, everyone feels the need to for this decoupling to be faster. And so a lot of regulations are going away. Um, this is one of the key points. Like, for example, the TSMC new factory that is live in the US. It was built in a special zone where basically a lot of rules don't apply. And so a lot of those are going to be true in the next few years because the pressing need is there and the geopolitical decoupling from China is happening, which is very true in the US, somewhat true in European Union, but like at varying level true anywhere. And if you look at China, China has built like the equivalent of the whole solar system built in the rest of the world in 1 year. And they're outpacing everyone in building new capabilities. And so the rest of the world is catching up, especially in the US. And my money would be on the US because everything can happen fast over there.
Yeah, so um that's interesting. I mean, I think since COVID, there's a lot of incentive for everything to decouple, right? And that's a big part of it. Um, and you said you're seeing the same trends globally. It's not just the US that are looking to couple from China. what does I mean, what does that look like? Because decoupling, the globalization trend has obviously good and bad parts to it. The bad part is inflation. So it effectively, we were outsourcing our inflation to China, but now we're reshoring it, which means inflation comes back. And I assume it's the same for other countries. I don't have that perspective, but I assume it's true. So how are countries kind of taking that? Because they're basically accepting higher inflation in exchange for reshoring.
Yeah. So physical production and like primary production is a trade-off. You have to take some pain, and the pain is the jobs over there are hard. There is inflation, and China had played that game for 20 years, and so they inflicted a large amount of pain on their citizens, and their citizens were paid less than what they should have been paid given their output. But China got paid in factories. And so the whole world understands now that they are in a weak position. And so they are reshoring factories. And so they have to inflict a certain amount of pain on their citizens. So the golden question is pain acceptance by all those populations. But it is very clear that there is no functional society where people who are not producing the things that they use um, are benefiting from another region being underpaid. This cannot last long. And so this kind of global leveling that we are witnessing, every single government is trying to do to push that. And so given the unique position of the dollar, it is maybe easier to do in the US because the dollar advantage is making it so that you can invest a lot, which is not that true in European Union, but at some level it is. And so everyone is trying to reshore. And yes, the inflation, yes, there is a certain amount of pain that those citizens must go through to have those factories back where they consume.
So, we talked briefly about the energy. What can be done to speed up energy or building of fact or plants in this case? Um, I don't know what people are doing around the world, but or if you have insight into this, but I'm curious because energy seems to be one of the things that takes the longest to build in terms of nuclear plants for obvious reasons. Do you see any sort of innovations being made there, or what is going to speed that up?
There is a lot. Um, if you look at what the biggest pools of money are betting on, short term, it's small nuclear reactors, and mid-term, it's fusion. So fusion has been 10 years away for 30 years now, so it's still not out of the lab. And so things are not very clear if it can become primary source anytime soon. But if you look at small nuclear reactors, like Microsoft got a deal with having a small nuclear reactor powering just one big data center. A lot of people are creating that. And if you look at the grand scheme of things, the grid, which used to be very, very large, long projects connected to the energy grid. And then like you have those long cycles and it's very hard and it's very hard. It's probably going to be smaller grids with smaller sources of power, especially small nuclear reactors, some solar, some blah, blah, blah. And so this should speed up a lot um, energy output. And as you know, AI is constrained by two things now, which is GPUs and energy.
Yeah, I mean the AI problem, I find it humorous to see that no one wanted nuclear until Silicon Valley decided, oh, we're in trouble. And
Yep.
all of a sudden, now nuclear's a thing because
Yep.
technology companies decided to think it was a thing because they realized. Do you think it's too late for them to adopt this stance? Do you think there's going to be a big gap in the energy need? Because not only is there an energy need for AI and data centers, but also other manufacturing that's going to be happening, which also takes up energy. What are your thoughts?
Ah, this is one of those situations where I wouldn't trade either position. Uh, I think there is so much money poured into innovative solutions that the outcome is very hard to predict. Um, if there are some fundamental research and development breakouts, then energy could become somewhat abundant. If there is no breakout, then energy can become more and more expensive and be the bottleneck to basically everything, including AI, but also manufacturing output. And so it's very, very hard to make the trade right now. So I'm kind of undecided, but I'm an observer of the situation.
Yeah, that's fair. Um, all right. So I know you work with a lot of manufacturing startups. What are the most exciting areas you're seeing in the manufacturing startup, space?
So I work primarily for tech companies that provide service to factories and everything. So I would say that 80% of my investment is done in software. Um, the first and the most exciting opportunity is basically AI agents for factories. So there is that company. It's not one of my portfolio companies, but that is doing the exact same thing that Tesla is doing with Optimus, basically humanoid robots that can learn without context and that can perform all the tasks that a human would do. But it is the same technology as one of my portfolio company that is called Vitesse. And Vitesse is basically teaching robots how to code. And so instead of a human having to code a robot so the robot can do a task, the robot auto codes itself and does the added value. And so I think a lot of value will be created in that. Another very exciting thing is that um, there is incredible innovation in material science those days. And so new materials discovered by AI, new materials just being discovered as we speak that have um, new behaviors. And so you can literally change a lot of things that are going on in factories and in physical products by doing that. Another huge trend is, of course, chips. Everyone thought before NVIDIA that chip makers were just in a race to the bottom. Turns out they are not. And there is, for now, no real physical limit to the performance enhancement that they can do. The latest release of NVIDIA is mind blowing. They achieved in like 12 months what we thought should take 6 years. And so this is very interesting. And the last trend that we are a lot looking at, it's very nerdy. It's called simulation. And so simulation software is basically before building a factory, before buying a robot, before doing a lot of things, you try to infer what will be your production process in a computer. And so this used to be bulky, not working really well, and you used to have all those tests, physical tests, having to physically build the product to know what the product is and how it behaves. And this is becoming less and less true. And we could get to a point where simulation is done almost entirely like in the digital world, and then you build your factory like in a few months instead of in a few years, and it works out of the box. So we are becoming closer and closer to those.
Nice. So let me ask you this, because I've been reading about this lately. What are your thoughts on the 3D printing manufacturing? What is that trend? Where's that going? Where are the opportunity sets there?
So there has been a lot of good progress. The thing is, the thing that 3D printing is very, very not suited for is material science. So when you compress a sheet of metal, you're actually giving the sheet of metal certain qualities. Um, and those qualities are very hard to replicate with 3D printing. So 3D printing is very, very well suited for certain applications where you ask from your product to be the right shape, but you don't ask from the product to have the right behavior with, I don't know, a shock or like a gear or moving parts in the motor or whatever. So a lot of people have been saying that 3D printing will replace everything and it will be the one and only thing. If you look at the numbers, 3D printing today is less than 0.5% of all value added in manufacturing processes. And I would be very surprised that 3D printing is more than 3 to 5% of all value added at any point in the future.
What are the limitations to it? Because to me, I don't know enough about it, to be fair. Um, but it sounds like I don't even conceptually, I'm trying to think how it would even be realistic that you could do it for everything, but people talk about that. So I'm very curious if it seems to be a small part of it, but why is it only a small part of it? Like, what are the limitations with that would keep it from growing past that?
There are two things. The first limitation is the pixel resolution because when you are doing additive manufacturing, basically you are adding things on top of each other. So when you're adding a thing, there is a resolution, which is kind of like a pixel, but in 3D. So if you have a certain pixel resolution, then the shape cannot be accurate at less than the pixel resolution. But a lot of 3D printers, they have been hard at work diminishing the pixel resolution. The true limitation is material science and the behavior of the thing. So, for example, if you do, so for example, your laptop, if you have a MacBook Air, is very probably stamped. The reason why it is stamped over and over and over again is because you have a durability that is like nothing else. Because when you stamp something, you are basically stamping the metal until the metal has incredible durability and maintain that silky smooth appearance. You cannot have that with 3D printing yet. And for very high performance applications, very likely it is going to be uneconomical to do it 3D printing versus stamping.
Okay. All right, that makes sense. But I assume there's probably a lot of things that you could
Oh
3D
yeah,
print
sure.
that are not
I,
technology related.
I would not be surprised that 3D printing overall market size is 5x, 10x from what it is today in 10 years or 20 years. But I don't buy 3D printing being dominant as a mean of production. It will be one of the tools. If you go to a factory, a given factory will have 5, 10, maybe 20 processes. It will have chemical manufacturing where you put some chemicals and you get the metal to do something. It will have stamping. It will have CNC machining. It will have a lot of different processes because those processes have strength and weaknesses and they are used for certain applications. And so manufacturing is the art of knowing what process to use when to have the optimal results with the less cost. And 3D printing is a very interesting thing in that tool belt, but not the one size fits all thing.
Okay, yeah, that's fair. So what do you see as the biggest challenges to implementing this? Because I mean, obviously there's a lot of global and all around pressure to go this direction, especially with the new administration, who's very clearly in favor of decoupling. Um, so what are some of the biggest challenges that are in the way of this? Because it seems like it's smooth sailing into this
Yeah.
direction.
So number one is talent. Um, Mechanical engineer pays a third of what a software engineering pays in San Francisco. So the best talent today is not going there. This is changing. There are some companies that are trailblazer, and very likely a lot of factories will have to change the way they're organized just to fit higher paying jobs and to fit talents in the equation. So number one bottleneck is talent, and also in China you have people doing CNC machining for 20 years, 20 years of experience, and a deep network. It is very hard to replace that overnight. If you speak to any CNC shop in the US right now, they will tell you that the know-how is lost. And so this will be number one. The TSMC chip factory, like the guys at the factory, they flew Chinese and Taiwanese people by the hundreds for 2 years to start the factory and train the people. That's how like zeroed out the talent pool is in the US right now. So that's number one, number one challenge, very clear. Talent and being able to pay for talent. So that's one. Second will be very probably one has to do to rebuild supply chains. And so, for example, Tesla, one thing that nobody understands is that it took like 6 to 7 years, but they rebuilt supply chains. They verticalized a lot of their production because the supply chains were all over and very dependent on China and everything. So, second is there is such thing as a critical mass of manufacturing hubs, starting at which you can have an ecosystem that works, and below that you have zero. So you have to get out of the ground entire supply chains. So that will be second. The third is capital, but there is enough capital and the need for that is so high. And the DoD has identified that having a good supply chain is critical in wartime. This makes it so that capital is abundant for the subjects. So it will be a list of the three concepts.
Nice. Okay. So any other trends you see that we haven't talked about that you'd love to let us know? I mean, I know we've talked about a lot of stuff today, but what areas you feel like we haven't talked about that are also important?
Yeah, as a deep nerd in the topic, I really love pharmaceutical companies. I know I'm the only one, but but I do love them. And there's a saying that the first pill costs 10 billion and the next one costs 1 cent, which is kind of true. Um, one thing that I'm incredibly excited about is bridging the gap between research and development and production. How do we make it so that the 10B is maybe 1B and the 1 cent is maybe 10 cents? There will be a lot of innovation in the space very rapidly, rethinking the entire supply chain of pills. And when I say the supply chain of pills, it starts at the ID in the research lab. And this is incredibly interesting. Like the supply chain of pharmaceutical companies is one of the most complex things that we humans have invented. And it's a beautiful topic to look at.
So why is it so complicated? I mean, the research and development obviously takes time, and there's no definitive timeline. It just happens when it happens. But when it comes to manufacturing the drug, um, also, you just said it costs 1 cent. I mean, the production of these things is not the expensive part. It's the R&D that costs so much money. So what is it about the manufacturing part of the drug that needs to change?
Pharma is the only industry where the main output of the factory is paper, not pills. The pharmaceutical production system main job is to prove that everything has been done to respect quality criteria and that it will not be harmful for patients. And it is the only, like, even defense factories are not like that. And, and so today, a pharma company will do what they call certification of a process. And certification of a process is this pill at this point is done by this machine, and then there is this machine, and then we do that, and then we do this. And so you certify the whole process. So you can think of like 100 steps. In the 100 steps, there are like 10 quality touch points, and you certify that. And then you need for 20 years to do that and nothing else. So it takes an incredible time to do the certification process because you have test and counter test and blah, blah, and blah, blah. And then you just run a process. And the main job of the process is not to produce the pill. The main job of the process is to produce the paper that shows that you respected what you said you would do. And so that whole thing is incredibly inefficient and long and costly and suboptimal. But this is the only way that pharmaceutical companies found to ensure quality by the millions of pills every day. And so if there was a system or if there was a way to certify output and not process, that would change the industry overnight.
Do you see a solution for that?
Not yet, but I'm willing to talk to any startup founders having an idea on that.
Yeah, that's interesting. I hadn't thought about it that way. I guess my hope is that we we move away from producing pills and maybe more towards healthy people, but that's a whole different
Yeah,
process.
I hope so. I
Yeah,
hope so.
yeah, but that's not how capitalism works. So, um, but interesting. I didn't know that about pharma. What other any other areas you see as interesting?
I love food. You mentioned the fact of being healthy. I have a deep belief that food companies are going to be the tobacco companies of our time. Um, and like I would bet a hefty sum of money that in 25 years the food industry is totally different. But I have no freaking idea how different and what to bet on. So I'm looking at the field, and there is tremendous innovation going on.
Well, this is a field I'm actually fascinated with, and there's really no profit to be made there for the most part. So
Yeah,
I'm not that interested from a capitalist standpoint. I'm interested more from a personal standpoint. When I think about food, you're right. Our food system has gotten corrupted, and in some sense globally. Although Europe has done a great job at keeping things a little bit more deterred from going down the road that we have. And you're French, so of course you love food. So you
of
guys
course.
have good food. You guys got great food over there. I love food over in France. But it's interesting though, because I know the technology around agricultural and farming is certainly there's a lot of people have come out with some stuff which is really fascinating to me. Um, but I think it misses kind of the main point, which is, we've industrialized food production, and that's part of the problem. And no matter
Yeah.
what technology you put in, you can cut costs, but if the quality is poor, it's not going to be as effective. I wonder, and the problem is the when I've seen the best kind of farming is really like regenerative farming. Um, there was a book, I forget what it was called, but I read it probably 20 years ago now. And it talked about, I think it was Saladin, Joel Saladin was the nature of the story. And people talk about him, but it was basically kind of regenerative farming on how all the problems that people have are solvable in a regenerative way. Pests and things like that are all solvable, but it's not as scalable, which is the problem. So you can't scale on an industrial, spectrum, this kind of farming, which is part of the problem. So how do you solve
I
both?
would have to maybe disagree with that.
Okay.
Like I was talking about humanoid robots. For example, there's that incredible startup in India. They are they are doing like bad weed fighting, but mechanically. So you have little robots going around in the vineyard and taking the bad weed one per one mechanically. And so you don't have to put chemicals in the thing. And so like I would bet a hefty sum of money that we have to industrialize and use technology for things to be healthier, but it doesn't have to be like picked by hand by a guy that is paid like minimum wage or whatever. Uh, but the intersection of technologically sound and that scales and healthy, I think it's fundamentally very different from what we have today. And so it will be interesting to watch.
Yeah, I agree. I mean, I think there's definitely technological solutions. We're starting to see some. We're starting to see, technological
Yeah,
monitoring of, how damp is the ground, like, and all these different things, which I think is great. Ultimately, if you have cheap food, which we have now, it's going to be hard to make the food more expensive. It's higher quality, right? Because then
yeah,
you can't feed everybody. And so there's definitely some social challenges that have to be
yeah,
met at the same time. But I am excited about it. I mean, I love the idea of that. I was actually just watching a video this morning, which I thought was fascinating. And I think I don't forget it was India or China, but there were rice paddies and they were putting crabs there, and the crabs took care of all the pests.
yeah.
They took care of the weed, they took care of everything. I was like, wow, that's a really innovative idea. I think it was China, come to think of it.
Mm.
And they just basically, probably changed the ecosystem, but put a bunch of crabs in there, and it was much better than any other sort of pest control that they had had. So I was fascinated to see innovative ideas like that, and I'm sure we'll come up with more as we evolve. But I do think it's probably one of the most important areas that we all need to solve because
And I have two data for you. Like I love data. So I have two data points for you that I think are very
yeah,
interesting.
please.
The first one is in Europe. I don't know about the US, but in Europe, the share of disposable income spent on food was divided by two in 50 years. So that's one. And second is if you want to predict any young person future income, one of the best predictor is the type of food that they were having as children. And the reason why is that caring parents with high social capital, they actually care about those things. And so I really think that we may see willingness to pay for great products up. Like Amazon bought Whole Foods, and Whole Foods used to be very high income, only very central urban, and it is getting less and less like that. If you look at the demographics that go there, even Chipotle of all firms are trying to get more healthy and everything. So I can see a macro trend going there, and also like with the new administration once again, I think the size of the scandals that are going to come related to food related diseases is just enormous.
Yeah, no, I agree. I'm on a personal journey with health myself, just trying to figure things out and just healthy eating and healthy living. And I'm constantly astounded by the corruption and it's not all corruption. It's more of just systematized lack of quality. Let's put it that way.
Yeah.
And there's reasons for some of it. Like I'm not, I've got a tinfoil hat here for effect, but I don't. At the end of the day, like some of this stuff is just basic need. Like if you have people who can't afford to feed themselves, they're not going to be eating at Whole Foods. So
Yeah.
people have to eat. And then the problem is what do they get? They get poor quality food, and of course that doesn't help them move up the economic ladder either. And as you said, I
Yeah.
mean the people who are successful predicted by what they eat. 100% true. And some of it's probably because of the quality, and some of it's just because, successful parents, they have money, they're smart, so they're going to teach their kids in the same way. So there's a lot of that. But yeah, I mean, food, the building blocks of life, something definitely needs to be done. So how much innovation's actually being done in that area from the manufacturing standpoint? I mean, I know I've heard some things here and there, but how much is actually being done?
I don't want to say zero, but the feeling is there. um, it hasn't started. There is not like in pharma, there was the CRISPR moment. Like you had CRISPR and then everything's changed. In car companies, you had the Tesla moment and then everything changed. In food, nothing happened. So they are still on the way. There is no, but I would expect something. Can it be business? Can it be a scandal? Can it be a breakthrough technology happening that will kickstart that deep change in the sector? If you look at, so the CEO of the Coca-Cola company, she's an incredible woman. She's really, really smart. And she basically owns Coca-Cola. And she says, okay, we are healthifying the portfolio of brands that we have, but at the rate that the consumer wants it. And so today it's like 15% of the sales. And so she's ready for when things will, like she owns like those kind of green thingies that you order on the internet, and you have some like vegetables in a bottle or whatever. Like they own that, but they are following the market. And so the market has not changed yet, but it will happen for sure. The golden question is the speed and what will be the defining moment.
Yeah, I think that's a good perspective. I like that. I hadn't thought of it that way, that we haven't had our Tesla moment or CRISPR moment in the food sector. Um, and yeah, but I had heard of one company, so it's correct. It's not zero. That may be the only company. Well, great. Well, Renan, I really appreciate you coming to the show and sharing your wisdom with us. I definitely enjoyed the conversation. Um, what else, as we kind of wrap it up, final thoughts you can leave our listeners, and where can people find more about you?
If you can work around manufacturing and technology for manufacturing, it's a fascinating topic. We should have more people working on that. And so, if you're young, don't consider that it's a dead end career. Come with us. It will be fun. We'll build things, and we haven't spoken about defense, but if you look at Russia war on Ukraine, it was logistics, like logistics and supply chain and factories. And a lot of the missiles are made by factories that were not designed to make missiles, but in 6 months they could. And so it's a very important topic. It literally powers everything physical that you can see, that you can touch around you. The chair you are being seated on, like everything is manufacturing, and it's a fascinating topic, and we should have the best and the brightest working on that and working on reshoring is very important. So if you can, please do that. That would be my main message. And so if you want to find us, we invest in incredible startup founders. We are always on the lookout for next opportunities. We invest at seed and series A stages. So please contact us on oss.ventures. If you don't have an idea, but you think that manufacturing is awesome, also contact us. And so we are based in Paris, but we are actually opening a bureau in Boston next year. So we'll be there.
Nice, nice. Well, yeah, when you open up the area, let me know. We'll grab lunch. This is great. I'm
For
looking
sure.
forward to seeing what you guys do. It's always been a fascinating area for me, especially since COVID when everything kind of changed, and so definitely stay in touch. Well, I appreciate you sharing your wisdom with us, Renan. We'll definitely have you back on.
Thank you. Thank you for having me.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Renan. Really appreciate him coming on the show. Now we're into the panel portion of the show where we have our very own Barb Freeberg. Hey, Barb.
Hi, Kirk. Happy to be here and have you all to myself.
Yeah, it's just you and me today. Happy New Year. starting,
Happy New Year.
starting it off right. Everyone's on vacation except for us. We're here for the duration.
I don't
So
know what that says, Kirk.
I don't know. I don't know. We need more friends, Barb, I think.
Yes, we do.
Well, we're adding some new panelists this year. We're gonna kind of mix things up a little bit. But yeah, this will be fun. So yeah, Barb, what were some of your takeaways from the interview?
My head is spinning. Change is very, very fast, and Renan did not let us forget that. He really delved into the changes in manufacturing. And I like the example of, yeah, chairs haven't changed that much. Well, I don't know if you watch TV. I certainly do. And chairs have changed too. They're selling these chairs, and on TV, it's like you get $500 off on this office chair. And I'm thinking, I don't even want to know how much the chair costs. So, yeah, change is rampant. And I think we need to talk about, what does that mean for us little people here on Earth talking about our investments and how the rapidity of change really across all sectors is impacting us on a day-to-day life and in our pocketbooks.
Yeah, I mean that's a really important question, and it's funny. I used to teach a class on this to advisors on the rapid rate of change, and what's interesting is, if you look back in history, like if you look prior to the internet, things worked a lot slower, and once the internet hit, things just sped up rapidly, primarily through information. But a lot of what we talked about was if you look back decades ago, where you and I thrived prior to the AI generation, all this, um, it was very different, right? Like when I grew up, you had one TV in the house. If you had one TV, you were middle class. Like you were doing okay because you had a TV. Wow. You had two TVs, woo, you're rich. Like it was very different, right? But the TVs were these huge boxes. I remember the family room. It was this big box the size of a big desk. And it was enormous. And it was filled with nothing. It was just this big box. And and the picture wasn't all that great. And how do you fix a TV problem? You just kick it, right? Just kick the TV and it'll eventually work, right? Things were different back then. And then when I forget when this started, but basically globalization happened, things picked up, and all of a sudden now you got a TV in every room. You got a TV. I got a TV on my phone. I got a TV on my computer. I got a computer in every room. Like things have changed dramatically, in the last 30, 40 years. And we've gone from this. I read a book and they talked about like a plunger, like a bathroom plunger. Like if you had one, you had one in the house. Now you got one in every bathroom, right? It's just the everything has become cheaper and more abundant, right? And in many ways, the quality has gone down too. But especially when you outsource to a place like China, my kids and I joke about their toys made from cheap Chinese plastic, and if you get the Bruder trucks from Germany, these things you can't destroy these things. These things are the best made toys I've ever seen. You could take that through a fire and they'd come out just fine. They're very well made toys. But then you look at all the rest of the toys and they're made like garbage. They're just like cheap plastic toys. When we grew up, they're made from like steel. It's like a Matchbox car was made from like steel. Like you couldn't wreck it. Now they just fall apart when they hit a bump. It's just a different kind of environment. And so when you look at the change that's happened over the last few decades, it's been dramatic. And for people like you and I, Barb, who've been through, more years than some others, we've seen both sides of this. And there's some good and bad that comes with it, right? The good is it's more abundant, it's cheaper. You can have, instead of one TV, you can have like 10 in your house and they don't cost that much. The price of TVs haven't gone up in a long time. Computers, when I went to college, my computer cost, I think it was like $2,000, something like that. And I had like top of the line computer at the time. It was like a Apple, whatever, 2GS or whatever it was. Anyway, now that same computer, so if you look at a 1 to 5 scale, like a one's terrible and five is like an ultra high end gaming computer, right? You look at that 1 to 5, the best value I've found was always at a 4. You don't get the very best, you get a step down from the best. In my opinion, it was always the best value because for what you're paying and how long it would last, I've got a Lenovo laptop. It was a 4 on that spectrum. It was still a gaming computer, but not the ultra high end. I still use it. it still works just fine. The only reason it doesn't work is because the software says, oh, well, your hardware is no longer supporting it. It works just fine. Like the speed is fine, there's no problems, but for whatever reason, the software is like, well, we don't support that anymore. But I had no problem with my high-end software needs. And so anyway, and this is like 14 years later. So my point is things have changed dramatically. They're speeding up, and it brings a lot of impact into our culture and our society. Where growing up, you appreciated the stuff you had. Like that was force fed into me being an old Scot. My dad was this old Scot, and we're not cheap, we're thrifty, but he force fed me like respect the stuff you have, appreciate it, and take care of it. Nowadays, it's like it's hard to share that lesson because it's so little to buy a new thing when it breaks. And things inevitably do because they're made cheaper than they used to be. In some part because it's planned obsolescence, but that's another story. Um, Anyway, so the point being is we're in a different culture where before things were made to last, and now you have to pay a lot of money to have something made to last. And it's a very fascinating change that we've been through, and we'll talk more about it. But yeah, to me, I find the whole thing really interesting, and the information change with the internet, the speed that sped up information delivery has dramatically allowed the world to connect. We're all this you know, people were in all these different places in the world and they had this different information and no one was sharing. Now everybody's connected. So you have all the same information, which accelerates progress. Good or bad? Let's argue. It's good or bad, but it accelerates progress in some direction because everyone's sharing information, both good and bad, because now you're not getting different opinions. Now everybody has to have the same opinion with politics. But if you look at it like scientists in different areas can share information, it's wonderful. So you get more progress quicker, and that is hard for people to adapt. So I don't know. That's my 2 cents, Barb. So
Well, you remind me with the rapidity of information of how to invest today versus how to invest decades ago. Because when I was a stock picker back in the 80s, the 90s, did a lot of research, fundamental research, and there were computers, but they weren't the sophisticated algorithms that we see today, the AI that we see today. And with judicious study and investigation and research, you could pick stocks that would outperform the market on occasion or maybe 4 out of 5 times. You always have a loser here or there, but um, it was possible. Today, I raise the question with how fast things change, how fast information is transmitted, and the abundance of computerized algorithms and computerized trading. The question remains, aside from Warren Buffett and a handful of others, can you really be a stock picker? And a lot of programs are out there, computerized programs, touting different methods of picking stocks or touting different methods of day trading. And yeah, you can beat the markets this way, you can beat the markets that way. But I want to throw this back to you because, and particularly after I got my MBA, I have become an index fund investor because a majority of research has shown that it is so hard to beat the markets. And those that do beat the markets cannot usually do so consistently. So I want to throw this back to you, Kirk. Do you think it's worthwhile to be a stock picker or to be a day trader or to really try and outperform the basic market indices, the S&P 500, the NASDAQ, the international indexes? Thoughts?
yeah, it's actually a great question. I'm actually doing I've done a lot of research on this, and I talked a little bit about this on the live shows that we do on Fridays. And here's the thing: when you, uh, I would say prior to the 2000s, uh, people were stock pickers for the most part. Some people were indexers, but indexing wasn't as much of a thing. It was a little bit of a thing, but in the 90s, everyone was a stock picker because the internet, right? And so after the internet blew up, people realized like I stink at picking stocks, which of course you did, right? It's like the internet, everyone made money. So if you didn't make money, what were you doing? But once people realized it's not that easy, they just said, well, I don't know what I'm doing. I'm just going to be an indexer. And there was this massive wave of indexing that started after that and even got worse in 2008 because then people really realized that they didn't know what they were doing. Even portfolio managers were buying the index ETFs in their mutual funds because they were like, I don't know what we're doing. And it was a crazy time. So what's interesting about the that question is that most people are realizing they should be an indexer because why pick stocks when you can just put it in the index and you're going to make money every year? It's crazy. And pretty much since 2008, people have made money virtually every single year. I think there was maybe 2 years in there where they didn't. One year was 0% return, but I think there was maybe like 2 years in there where they didn't make money. But pretty much it's gone up. It's gone straight up for like whatever that is, 13 whatever it is, 15 plus years. Um, and so what's interesting is we talk about this a lot in the show is that people should invest with their own investor psychology. You should not try to be Warren Buffett if you're looking for action every day. You're just going to lose money. It's just a bad recipe for disaster. You should also not try to be a day trader if you're wired like Warren Buffett, right? So you need to understand your own investor psychology and what works for you. Um, and maybe you should be an indexer because you're a gambler and you have a problem gambling. You could call it day trading or you can call it investing, but if effectively it's gambling, you don't know what you're doing and you're just like punching buttons on a keypad, you should be indexing. Like you're your own worst enemy. But you need to understand where your psychology is so you can reinforce that with appropriate behaviors. So, for instance, if you're a gambler, you should put all your money in an index and never touch it. Like you're prone for disaster. Um, but if you're good at day trading, then you should align yourself properly with the right things. And maybe investing like Warren Buffett's not your thing, right? Or vice versa. So I think the challenge is you first of all you need to find your own investor psychology to invest the right way. Now, the indexing problem is actually pretty huge. So the indexing problem is this: more and more people are indexing, and this is causing a lopsided market. So I think right now it's I had this for the live show, so I'll have to pull this information up, but it's somewhere in the neighborhood of like 30 or 60 trillion dollars are in um are in index related investments. It's crazy. Like it's a crazy number. It's somewhere in the neighborhood of like 40 to 50% of the market is indexing. Now, and I mean the S&P 500, not the other indexes. Um, so when you have that much, it might actually be higher. I haven't looked at the recent numbers, but when you look at the market and it's primarily driven by a non-thinking machine, which is basically I put in $100 every month into my 401k and it goes into an index. Or I put in to my Fidelity or Schwab account $1,000 a month and it goes into, the Vanguard S&P 500 index, right? If you have that mechanical behavior, which a lot of people have, which in many ways is good because it reinforces good behavior and good patterns of investing and saving, right? The problem is when everyone does that, what do you think's going to happen? Let's just take this vacuum tube example, right? We're doing this in a vacuum. So let's say everyone does the same behavior. Let's say everyone's got $100 this month and every single person invests that into the S&P 500. What's going to happen? Well, it's obviously going to go up, right? What's going to happen next month? It's going to go up again and again and again and again. It's just going to keep going higher. What could possibly be wrong with that? Well, I'll tell you what's wrong with that. What about when people start pulling money out because they need it, or, whatever, there's a recession or whatever happens? All of a sudden, you have this market that's not operating in a normal way. You might say, well, it just keeps going up. Yeah, but what if there are no more buyers? Because at some point, people pull the money out to retire, right? There's no more buyers. That's the peak of a bull market, when there are no more buyers because everyone's already bought. The peak of a bear market is when there are no more sellers because everyone's already sold. And so what happens is you get this, and I'm saying this because philosophically, this is an interesting question. And a lot of people have tried to poke holes in this. I don't know where this actually turns, but let's say there are 100 people and 99 of them are investing in the index, and I'm the only one investing in stocks being a stock picker. Who drives the market? I do. Because I'm the only one making a rational decision. Everyone else is just putting money into an algorithm that's saying, well, 5% of it goes into Apple, 4% goes into Google every single month. But if I'm the one, let's say I have $1 billion under management and I'm managing money and I decide to short some stock, I'm going to drive the market because I have price discovery. Price discovery is through me. I'm the one making a decision. No one else is thinking. You want to know why corporations are not bound to their shareholders? Because no one is making decisions. You know who's making decisions? Indexers. They're voting the shares or not. I don't know what their policies are, but shareholders are no longer controlling these companies because it's owned by big corporations who either have their own agenda or don't care. So it used to be corporations are owned by shareholders and they would make the individual decisions. You and I, Barb, would sit here and say, I don't think Disney's doing a good job. I'm going to vote out the bums in power. You could do that. That doesn't happen anymore because indexing has basically coerced this free market mechanism, and now it's just this other thing that is no longer a free market. You don't have price discovery in the same way. So it's distorted the market. I don't know what the result ends up being. I've thought a lot about it. I don't know. I just know that what ends up happening is the more and more that's the market's driven by this machine, at some point, the people who are doing the price discovery, the me's of the world that are buying and selling stocks, we control everything because no one else is making decisions. They're just blindly doing stuff. I can drive the market because no one else is making decisions. It's a warped market. It doesn't make any sense, and I will tell you, it scares the crap out of me because I don't think that indexing is a bad thing, but I think if everyone does it, it is a bad thing. Anything with everyone's doing is always bad in the markets, right? If everyone's on one side of the ship, it'll capsize. And, people run to the other side of the ship. It capsizes that way and back and forth. That's what makes markets. So um, I think that people need to invest in the way that need to invest best. But I do think that the individual, the smart portfolio managers, the Warren Buffetts of the world, right? Which, by the way, he's drastically underperformed his own goalposts for quite some time because he's not living up to his own rules. But somebody like that, um, he's making smart decisions, and I think that pretty much everybody should be finding a way to make smart decisions, even if those decisions don't lead to the same results as the Magnificent Seven. Because now everybody's just dumping money into tech, which means that the stocks go higher, which means more money is put in there, which means the stocks go higher, which means it's a positive flywheel. So this indexing is basically creating this positive flywheel that keeps it going higher. So my point, to wrap it all up, because I've talked a lot, is there's something that people are talking about behind the scenes, which is the relentless bid. Now, the relentless bid is basically this: is the stock market ever going to go down again? It's an honest question. Is the stock market ever going to go down again? Because you have this relentless bid of index money going into stocks, continuing to push it up. And I'm not saying that it's good or bad. I'm just saying that it's not causing true price discovery. Because if we have a recession and the market goes up, well, I mean, it's crazy. Like, put all my money on black and just it's going to keep going up every year. I mean, that's distorted. That's a problem because at some point it's going to really, really be a problem. Like at some point, people are like, all right, I'm out of the casino. I'm taking my money out, and then it goes down 70, 80%. Like that's kind of how things happen if you allow this sort of thing to happen at some point. So the question is, if we go into recession, is the market going to go down? That's the question I'm asking myself right now. This year is interesting. I'm curious in your opinions on this year, Barb. This year is going to be interesting because we've got a lot of dynamic factors. And I think at some point we're due for recession. I think within the next 12 months, we're bound for it because of many reasons, which we can talk about. But I wonder if we will because of this relentless bid. And that scares me because I'm not investing with logic. It gets into this gambling, quote unquote, gambling realm where you know that something doesn't make sense, but you're doing it anyway. I put that in the gambling category. I think it's stupid, but it's hard not to. That's the problem. So I don't know. What are your thoughts for this year? We got a lot of dynamics, new administration. Where do you think things are going, Barb?
I've been thinking about what's going to happen this year a lot. And yesterday I was doing some research into the valuations of the stock market. And I'm at my core a fundamental investor, which means I look for the true value in a company, the intrinsic value, which is measured by a lot of different ratios. One being the price to earnings ratio, which is the price of a company or an index divided by its earnings. And in layman's terms, it means what are you going to pay for $1 of earnings? Higher means more expensive, lower means less expensive. So, what fundamental investors usually do is we compare a metric like the price earnings ratio and many others to its history. And if it's way above its history, its historical value, well, then it's suggesting maybe the stock market is a little overvalued. And yesterday I was looking at the Shiller PE ratio, which is another way to measure it using 10 years average earnings instead of just recent earnings. And it is now at about, the Shiller PE ratio is about at 37. The average is somewhere around 15 or 17. So you do the math. That's double what the historical average is. Now, the low price earnings, Shiller price earnings ratio was 4, which was in the 20s, 1920s. The highest was 44, which was in the end of the 1990s. So we're getting up there at 37. And the theory goes for us fundamental investors is, and this has happened in practice as well, at some point, the valuations of the stock market, including the price earnings ratio, will revert to the mean, which is will go to their average. And that can happen in two ways. One, and the most common way, is that prices fall. Unless your earnings are going to ramp up really high, which I don't see happening, prices fall. And that's happened over time, cycle and cycle again. Does it mean they're going to fall this year? Well, that's the problem. We don't know when markets will return to fair value. It could be this year. It could be because the markets can be overvalued for years and years and years and years. So I'd posit, Kirk, that yeah, we're going to have a recession sometime. And yeah, the stock market is going to have a crash. Put my money on it. But don't ask me when. And that's the $1 million question. Because if you knew when, well, then you'd be really, really rich and you'd be ahead of everyone else. But nobody knows when. And that's the scary part because we're investing, we've been told to invest regularly, and over decades and decades and decades, the stock market has trended upwards. But when you drill down into individual decades, there are decades like 2000 to 2010 where, because the stock market was so overvalued at the end of last century, the market had a big fall at the beginning of this century, and the first decade returns were 2 or 3% per year on average. So, what does that tell you? Well, it tells you we're not sure what's going to happen, but it does suggest that sometime within the future, you're going to see the stock market fall. I know I don't think you believe this either, Kirk, but I don't think we're coming into a period where the stock market is never going to drop. That just doesn't seem right to me. So it posits the question, Kirk, what do you do with your portfolio when the stock market is really double its valuation of the average?
Yeah, it's a good question. And I pulled up some of the data I was reaching for when I was talking. Um, so the price to book is a 20-year high. The price to sales is at, I think it's at least a 20-year high. Price to sales is above three, which is kind of crazy. Price to book is above five, which is also crazy. Of the markets, the Buffett indicator is like 207%, where normal is about 100. So, so if you notice, Warren Buffett's taken a lot of his portfolio and put it into cash. A lot of big name investors are putting their money and putting it into cash. Um, I think the challenge is, when you make big decisions like this, a lot of people I follow that are very spot on things are moving money to cash and selling positions because I wouldn't say they're spooked, but they're, let's just say, being cautious because things are expensive, and we had a huge run last year in the market, which was undeserved, in my opinion. Um, the markets went up, and I feel like we've got a new administration with some big changes, which I don't think people truly understand yet, in part because it's been very clear. And I think Trump definitely does what he says he's going to do. Like he's not like a Bush read my lips, no new taxes kind of guy, but we don't know the impact yet because we don't know how he's going to do it. And I think that's the thing that it has some people spooked. I think also the other thing, I was mentioning the relentless bid. So in 2010, there was $258 billion going into index funds. In 2025, there's 600 billion going into index funds. In 2013, there were 36 million participants investing in 401k plans. Now there's 80 million people investing in 401k plans, most of which are going into S&P 500 index. Now there's more than 15 trillion in assets linked to the performance of the S&P 500. That's enormous. Now, I mention this in contrast because if you look at, I don't know if you remember this, Barb. Remember those old charts which shows 100 years of market performance, which shows stocks, bonds, S&P, small caps.
The value line book as
Yes.
well, where you had the book of the stock market charts and data on separate pages.
Yeah, and the one thing I remember when I started is they had this wall map, and it was just like this big chart you could put on the wall and would show a lower left to upper right and how everything performed.
I
And
loved that chart, by the way. I loved that because also there were portions where it would have overlays of recession, war, whatever, and you saw how the market performed during all these different conditions.
yep, and you had presidents on there. It was all sorts of stuff. It was really cool. It was great data. Now you can get that pretty easily, but back then it was kind of cool. Well, what was the best performing asset on that chart always?
Uh, the stock market?
Yeah, which one though?
Oh, um,
Which market cap index did the best?
oh, small caps.
Exactly. Small
Sure, sure.
caps
Yeah, yeah.
blew
Small
everything else.
caps.
Yeah,
Oh,
blew
yeah,
everything else out
yeah.
of the water. But
Over decades and decades.
yeah, over 100 years, it was the
Sure.
best performer by a long shot. It wasn't even close. However, if you look at the stock market now, how's small caps doing? Not very well.
Don't
They're doing all
remind me.
right.
I am still hopeful that the theory with why small caps did so well is because you think of the possibility of how easy it is to grow your earnings if you're, you know, 50 million dollars, $10 million company. It's really easy to double and triple your earnings. When you're a $1 billion company, it's not so easy. So logically you would think, yeah, small caps for sure continue to outperform, but not since 2000.
So if you look at yeah, so if you look at that, if you look at the performance, part of the reason was price discovery. So you did have price discovery back then because you still have it now. And this is the point. With the S&P, you stopped having price discovery when mounds of money came in from the indexes, from the institutions that all invested in big, large cap or mega cap. You have a lot of money pushing that higher. And you don't have that for small caps because if you've got, you know, $50 billion fund, you can invest in small caps? No, you can't. It would move way too much. You couldn't get in, you couldn't get out. It's not feasible to do. So, I mean, if you look at Fidelity, and I'll share some inside tips that somebody at Fidelity told me, and I'm sure they'll deny it, but that's okay. They deny everything. What they told me is Fidelity, they'll have if for one of their managers, um, they'll charge you like a fixed fee, like 1% to manage their funds. They'll put you in a bunch of mutual funds. There might be like 30 or 40 mutual funds. I don't know if they still do this, by the way, but they did for at least 15 years, where they would put you in like 30 or 40 mutual funds. Well, the reason, because you don't need 30 or 40, but the reason they would do that is because so many people put money with them that if you had only eight, those eight would become too big and then they couldn't manage them. So it was more of an operational, practical issue rather than this is the best fund. It was more like, well, we can't move the market too much. So, and it was crazy, but that's the kind of things that happen. It's not just them, it's everyone else has the same problem. So it's much easier just to dump money into mega caps because they can take it, right? They take the big institutional money, but the small caps, the institutional money doesn't seek it out because it's too small. So what you tend to have is you tend to have price discovery because you have managers that are in there buying and selling the small caps based on fundamentals and technicals and things like that, the way the market should operate. But you don't have this pile of money, this relentless bid moving the markets. So what I find interesting is when the S&P is consistently outperforming small caps, that tells me we have an unhealthy market. That tells me that the market is not operating the way it should. Now, it doesn't mean that they should always outperform large caps. That's not what I'm saying. But for since 2000, 25 years, come on. The reason growth has outperformed value for 25 years, come on. That's not how the markets operate. It's one thing to have growth outperform for like a period of time, like 7 years, 8 years. Okay, I'll buy that, but not for as long as we've had it. That is not a healthy market or a normal market. Value stocks should perform reasonably well, but they're not in comparison because it's like the internet boom. Why did internet stocks do well? Because everyone just kept pumping money into them. They didn't pay attention to it. That's what's happening with indexing, with large caps, with mega caps, is people just keep throwing money at them, whether they deserve it or not. And that's the problem, is that you have Nvidia, which is through the roof. And my disclaimer is I'm not recommending or not recommending any stocks. This is just for illustrative purposes. But if you look at a company like Nvidia, which is I don't know what the PE is, it's crazy, it's too high. Um, all the metrics, fundamental metrics are way through the roof. You could argue, well, they've got a lot of growth out of them. Okay, I'll buy into that argument. I mean, I don't know what the reality is, but it's gotten so far ahead of itself that they came out with good. They had an event. I think it was on Monday, And they came out with some really cool stuff, a good new supercomputer or something that they were doing. I was like, wow, that's really cool. The stock dropped like 6%, or maybe it was more. I don't know. But the point being is it's priced to perfection. So when that happens and you come out with good news and the stock drops, it means it's way overvalued. That's how the market treats overvalued stocks. Point being is if you look at something like small caps, that still have price discovery because of the nature of the lack of institutional support in mass. You still can get price discovery. And so if you have small caps kind of underperforming or just kind of treading water, that means that either A, um, you have the relentless bid that's not going away, or B, you should probably take a pause and maybe consider your options. Whether you should consider continuing to invest in equities because maybe they're overpriced, because small caps, they're not falling because the market's got a relentless bid, but they're not exactly climbing with the market, which they should. So that would be my kind of tip or trick for the week is, look at contrast for other markets and how they normally should operate to see if they do. Europe has been in stagnation for the last 25 years. Japan has finally gotten out of its recession or deflationary spiral, which I guess in some ways they're still in, but the stock market has gone up in large part because the central bank has bought like 90% of the index, but that's a whole different problem. But the point is that that market's going up, but most of the other markets across the world are not. And so it's just something to think about as you're looking at your investments for the coming year. Don't just put money into the market because it's going up. Look at why do you think it's going up? Why do you think it will continue to go up? Because the past is no indication of future results. So you have to consider if you're Republican and you're pro-Trump and you love the fact that Trump got elected, don't take that as a license to just go all into the markets because you think he's going to do a good job, right? And if you're a Democrat and you hate Trump, um, and you think he's going to destroy the markets, don't use that as a reason to get out of the markets. Use logic that has nothing to do with your emotions. Now, um, I've expressed in the show towards the election that I was for Trump, not because I like him, but just because I thought he was a better choice, which didn't say a lot. But I think that his policies are interesting, potentially disruptive. They could be good, but they could be disruptive. So I'm on the fence. Like I like his direction, but I also think that the policies potentially could be disruptive. So I'm a fence sitter right now. I'm not all in, I'm not all out. I'm just kind of like waiting to see how things play out because a lot of what he's doing could be very inflationary, some of which could be deflationary, but I think that if you look at things like ag, he's trying to get rid of illegal immigration. Well, that's going to impact the ag sector, which means our food's going to be more expensive because now you got to pay more expensive labor to go pick the stuff or find machinery to do it. But point being is you're getting rid of basically free labor because they're getting, migrants that you pay nothing to pick crops. That's going to cause food prices to go up. Tariffs are going to cause goods and service or goods to go up. If you income taxes lowering that uh, could potentially cause inflation because now you got more money to spend, so people spend more money. So I don't know where all these policies land. So I'm like I said, I'm hedging my bets because I want to give the policies the time it deserves to understand what they're actually doing, because tariffs has been a bat that he beats people with to negotiate rather than being a forefront policy. It's not like, well, I believe tariffs are the thing. He just says, well, let's do tariffs. And if you don't like it, well, then I got a tariff on you. If you do like it, well, we'll take it off and we'll do something else. So I don't know if it's strictly negotiation or if there is some uh, method to the madness behind there. And I haven't seen it, which is why I'm giving it some time. Like I don't understand it. Nobody's explained it. So at the moment, I'm just waiting to hear an explanation. And until then, I don't think I think it'll be inflationary. Point being is inflation is not kind to the markets. So what I think will, if I had to bet right now, I'm like 50-50, but if I had to bet and put money on it and pick a side, I would pick on the side of it will most likely be inflationary. I think we have inflation coming back regardless of Trump's policy. So I don't attribute it all to him. I think we have that resurgence of inflation, which has started to come back towards the end of last year. Um, So I think it's probably situational and policy related. But I do think we'll probably have inflation, which will cause disruption in the markets, which means that we should be really hedged with our risk, which we are. But I think people should be considering that and not just be full on. I'm putting all my money on black and we're going to let it ride. Don't take that approach this year. I think that's a I think that's probably a bad choice. And even if you like Trump and his policies, I think you should definitely be cautious of your risk and know what your risk is. Just know what it is, right? If you're investing in things that are beaten up, great. Then you probably won't get beaten up so much in a recession. But you should consider the fact that we could have rough times in the next year or two. From what I'm seeing, we should probably expect a recession in the next 12 months, 6 to 22 on average, but in the next 12 months, I think we should probably see one. Um, I think my prediction is when the inverted yield curve comes back and reverts to normal, which it has. We've got about 6 to 22 months, so pretty much sometime this year, early next year is when we should see it. Um, but you know, Trump could upend that by doing some things that are different. And I'll give you one more thing, and I'll pass it back to Barb. Um, the problem with this country is too much debt, right? We run a deficit every year in our budget, and then we have way too much debt that we can't pay back. It's just not possible to pay it back. I'm not saying we should, but we can't. So the ways you deal with that much debt, you either grow your way out of it, you inflate it away, or you default. Those are pretty much the three situations you do to deal with too much debt. Um, Default is not an option. That's the last resort. Nobody wants to default. That's a really bad scenario. Uh, Inflate your way out of it. That's what politicians do. That's just generally what they do, and that's what we've been doing for since the beginning of time. Because it's free and no one knows it's happening. It affects us all, but it's silent. It's a silent tax. So they're going to do that for sure. But the other one, grow your way out of it, is really hard because we're too big. Here's an interesting thing. Somebody raised this on X, and I thought it was an interesting point that um, let's say I think it was Michael Saylor actually, to be honest. I think he was the one that raised these. Like, what if you took 1 million Bitcoin, whatever it is, and you put that in the U.S. Treasury reserves, and then Bitcoin grew whatever 20x or 30x or whatever it grows from here, 50x, and then it continues to grow, and it grows well past our debt. Well, now you've got an asset worth, I'm making numbers up, $1 trillion when we have $500 million in debt. Okay, now we have basically, quote unquote, grown our way out of our debt problem. Now, it doesn't mean you pay off the debt. It just means that you have an asset that is offsetting it. So, uh, just philosophically talking here, because I don't know if this will actually happen, but it's an interesting thought experiment. Because can we find ways to grow ourselves out of debt? Well, we'd have to stop putting ourselves in debt, first of all. And second of all, we'd have to have massive growth, which is hard to do in this economy. So um, it could happen, but it's hard. So we have to expect inflation. I think that unless Trump can come up with some genius solution, which, like I said, I didn't think there were any, but Saylor came up with an interesting idea. And so I'm open to the fact that people can come up with interesting ideas. I think it's just really hard to do. So the most probable scenario is inflation, which means that we're going to have higher inflation in the next few years, and people should be prepared for that, and they won't be. But for listeners, prepare for that because it's going to be a rocky road. What are your thoughts, Barb?
I hate to admit it, but I probably agreed with 90% of what you said, which, Kirk, that's kind of scary
You
because I
hate
do,
to agree with me, Barb?
I
Come on.
do, I do. I hate to agree with you, but I hate to say a lot of what you said made sense. But the one thing I can guarantee you, 100%, the future is uncertain, and no one can predict the future with certainty. And I want to hop on to what Kirk said about hedging your portfolio. Now, what does that mean and how do you do it? And number one, I think one thing you should be prepared for is understanding what your portfolio would look like if we had a 30, 40% drop in the stock market. and do a little math and do what we call a pre-mortem so that you're prepared. So if you have an 80% stock, 20% bond portfolio, and the stock portion dropped 40%, then understand what the total value of your assets will be, number one. And number two, can you live with that? Okay. If not, then you want to lighten up on your stock portfolio. And how do you do that? Well, maybe put some money in high yield cash. That's one way to hedge. Now, over long periods of time, high yield cash has never been the highest yielding asset class. But what it does do is it at least protects the principal value of your investments or your money from loss. And it's not suggested to be a long-term solution, but those of us who are, nearing retirement, in retirement, and don't have a lot of time to make up losses in their stock market portfolio might want to consider not being really aggressive as an investor. So, really fun conversation today. I am Barbara Friedberg, and I will have an article coming out within the next couple of days on Barbara Friedberg personal finance, which touches on this issue, even though it is called How to Invest Large Sums of Money. You can also find me on YouTube. See you next time.
Thanks for coming on, Barb. And Barb says the one thing we can't do is predict the future. I'm actually going to predict the future right here. And I guarantee you it's going to come true. Here's the future. This year, 2025, the market is going to go up, it's going to go down, and it's going to go sideways. And not necessarily in that order. So that's my prediction. I guarantee it to be true. Prove me wrong. Uh, anyway, we like having fun here. So that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.